we have to kind of put up those warning signs, right?
Of
The
course.
risks and everything like that, so that people are understanding, look, real estate is great and long term, it produces some great returns, but what are the risks for a lot of retail investors, getting into real estate? I mean, we talked about it when you're doing it on your own, and
Yep.
certainly part of the problem is it's hard to diversify, right? You're a
Yep.
lot of times in a single property. But what are some other risks that people should know about, especially with this very changing environment between mortgage rates skyrocketing, inflation rates being up so much, the pandemic aftermath, supply chains? I mean, you name it.
Yep.
What should these guys know about?
Yeah, I would say the biggest single risk historically within real estate is that it's illiquid. So,
Yeah,
if you go into buying one of these multifamily units or your own house, there's no quick liquidity switch to be able to get money out as you need. And of course, there are people who are trying to build solutions. We've built a secondary marketplace, but the reality is that there's no quick, efficient liquidity, unlike the equities market, where you can get liquidity within hours or days.
hmm,
So I'd say that's risk number one. I'd say the other is real estate is a space and a sector where if you don't understand, or if you don't have a great steward looking out for you, deploying capital, you can lose all your money. You can get wiped out. If you ended up, for instance, investing in a shopping center a few years ago, those spaces and asset classes have fallen so hard that it'll be really hard to recoup your principal, your value, because there's a lack of liquidity. You're sort of at the you're at the beck and call of whoever is running the property day to day as to whether or not they're going to increase the value of it such that you could recoup your principal. And then I think the final risk that we always call out for people is that there are a lot of tax and local ordinances in certain areas, zoning restrictions that can change based off of different politics, right? So you
right.
could have invested in multifamily property in Los Angeles, thinking that the current zoning rules made it really hard for other people to build other competing multifamily, and that can be changed. Someone can come in and say, what, I actually want to expand, the zoning sort of framework so that anybody can come in and build, and you can see a lot of value eroded. So just understanding that real estate's a hyper local, almost street by street business. It just means that you need to be working with people who really have teams and great boots on the ground who
Yeah.
understand everything happening in the market. So those are some of the key risks.
So what about being an accredited investor? Because you highlighted all these risks, and so one reason that you had to be an accredited investor in the past was you had to be a little bit more quote unquote sophisticated, right? Do you still need to be an accredited investor to invest and take advantage of some of these opportunities?
Short answer is no. I mean, one of the exciting dynamics about real estate, investing with some of the new legislation, the Jobs Act, and others, and some of the new products that have been developed, is that anyone can invest in real estate. You don't have to be accredited anymore, and that's great. It also presents some risks because there are a lot of people who are sharks, frankly, in the space, who are looking to find people who don't really know how to discern and pick and choose
Right.
managers, properties, geographies. But there are increasingly products. We're launching our first ever, called the Cadre Horizon Fund, that give individuals, accredited and non-accredited alike, the ability to invest in direct real estate portfolios, get good income, and get the long-term yield and growth that real estate provides.
Mhm. So talk a little bit about how you've set up the Cadre, Cadre itself, and specifically the Cadre Horizon, since that is available to retail investors and non-accredited investors. So is it that they just basically trust you to build the portfolio for them, or is there an a la carte menu? I guess, like, I want to be in this area but not this area.
Yep.
How does that work exactly for the investor to make some decisions, but not have all of the I guess, the risks involved.
Absolutely. So I founded the business in 2014, and when I started Cadre, initially we were focusing on larger, more quote unquote sophisticated investors.
Hmm.
So all accredited, even some institutions, and giving them the ability to invest deal by deal. So pick and choose a la carte. And that was really to prove out the model, to show that it was possible to invest through this technology interface we built that just made it more transparent, so everyone could see each deal and each property type and the growth and the business plan. The analogy I've used is almost like getting a baseball card that gave you all the stats and all the data and the images of a given property, and you could say, you know what, I want that baseball card. I want to buy, a stake in that building. And that was the predominant way people invested, deal by deal, had to be high net worth up until about 2018. And then in 2018, Goldman Sachs approached us, and they said, we really like what you're doing. Would we be able to give our clients access to a portfolio of real estate offerings? So we said, well, of course. And we built the portfolio for those clients, and for dozens others, raised hundreds of millions in capital, and let people build their own separate managed accounts where they could invest in 15 to 20 properties. They told us their risk appetite, and then we bundled these portfolios together. And then we decided that we wanted to bring these portfolio offerings to a wider range of investors at lower minimums. So during the pandemic, we launched the Cadre Direct Access Fund, raised a few $100 million, had folks like Harvard and BlackRock and some foundations invest, but we also had a large number of high net worth investors invest for $25,000 in a portfolio of about 15 properties. They still had to be accredited. But in that scenario, you could either get access to this, fund offering that has now generated more than 40% net IRRs for our investors, almost doubled their money based off some of the sales that we've offered to those LPs and clients. Or you could pick and choose properties that were also in the fund. So we'd hold back a little bit of equity. So it was, kind of like a passive investing sort of experience, which is the fund, the portfolio, or active investing, picking and choosing. And because we've amassed more than 4 billion of real estate, and we've allowed thousands of individuals to invest, I made the decision that I wanted to now take the next step in our growth. So we'll be the only platform in the sector, in the world, as far as I know, where individuals can directly invest alongside some of these larger institutions.
And they're able to do this through like retirement accounts and things like that, or is it outside of that stuff?
Yeah, so individuals can go to cadre.com, cadre.com, and basically sign up. Once they give us just verification ID, they're in. You don't need to pay a subscription fee. You don't need to know the right people, and and have that network. We want anyone to be able to invest, and we want people to be able to invest through different means and avenues as well. So you can invest directly, you can invest through your IRA, you can invest through your advisor if you have an advisor or someone who helps manage your money, or you can invest through a trust, or and so we've set the fund up such that the biggest number of people, the greatest number of folks can invest in high quality real estate and benefit the same way some of the larger family office and institutions have historically, and through our platform, frankly, as well.
Hmm. Now, I want to get into something that you mentioned earlier. You were talking about kind of the ability to solve the illiquid problem by kind of building the secondary market. And one of the challenges I expect is kind of that valuation of the properties. I mean, one of the things that just as I started getting into real estate, and again, this is because of my wife. She's been in commercial real estate for a while, and you know, she had to really kind of sit me down and slap me over the head a couple times, because the valuation thing is so different with commercial properties, versus residential, single family home. Your personal residence, you think of, oh, I got to go get the comps and an appraisal and everything like that. Whereas with the commercial property, a lot of times it's about your occupancy or everything like that. The distressed properties, it's a low occupancy, and you can raise that occupancy, and boom, the valuation just changes. So how do you kind of do that to create a secondary market and have that valuation done appropriately, I guess?
Yeah, no, it's a great point. Your wife is spot on about the valuation dynamics. We have quarterly valuations. We go through a
Okay.
pretty rigorous process internally where we're getting real-time data across every property we own. Plus, we're overlaying that with market data. So what's going on, from a growth perspective, a cap rate perspective in that respective market, and then we're coming to a net asset value that we then have sort of validated by a number of auditors and third-party appraisers as well. So it's not just the Cadre opinion of value. We've
Right.
also had others as well say this is something that can be defended. Here's all the supporting data, and that valuation is, I think, frankly, as rigorous as any I've seen. It's our way to market the assets themselves, and it's not just our opinion, and that ultimately is what investors can trade on, right? They can trade at discounts or premiums to that net asset value. We've had hundreds of investors use our secondary market, which doesn't exist in any other platform. And it was a long, arduous process to be able to offer liquidity quarterly to our investors and the opportunity to have liquidity. But basically, we see this as sort of an exit or escape valve to the extent life
Right.
circumstances change or people want to reallocate or rebalance. But it's a pretty arduous, rigorous process. We go above and beyond to make sure that we can support the values that we list, and we have other third parties do the same as well.
Mhm.
What about competition? So I'm assuming there are a number of players starting to come into this and really competing for a number of the clients that you have or you might be trying to get. Talk a little bit about that. Yeah, and I think with that technology kind of advantage that you were talking about and offering this secondary market, that's a real kind of cool differentiator. But talk about kind of the competition. Is it really competitive right now, or is it starting to kind of slow down and bigger players are starting to rise up?
Yeah, so from a competition perspective, what I would say is that what ultimately matters is trust, and
Mhm.
the platform that builds the most trust with investors will be the one that ultimately is the fastest growing, can scale the best, and trust comes from performance.
Yep.
And in our case, we've generated 27.5% plus net IRRs for our investors. There's no other online real estate investing platform that's anywhere near those consistent returns that we've been able to generate. And so what we oftentimes see is that a lot of the investors that we are talking to, they're looking at private equity funds as the alternative.
Oh,
Some of
interesting.
the big institutions who do have a pretty strong track record, those are the folks that have the most comparable performance to Cadre. The challenge with many of those private equity firms is none offer a very efficient, direct way to invest in their funds or their properties. You need to either have a lot of money, and I'm talking like high seven figures, low eight figures type money. You need to invest through an intermediary like a wirehouse or a bank or an advisor, or you need to work there. And so in Cadre's case, we're able to offer people the ability to directly invest in these buildings for fractional stakes or in portfolios or funds without the middlemen that can eat away a lot of the returns, and to do so with a platform that has a credible team. Our team has more than 40 billion of deal experience. I co-chair our investment committee alongside with Mike Fascitelli. Mike used to be the CEO of Vornado and head of Goldman's real estate group. So we're bringing this institutional real estate to the masses. And in some ways, we're kind of in a class of one, in that we're not a crowdfunding website that's just putting anything on the platform and saying buyer beware. And we're not a private equity fund in that we're not charging multiple layers of carry and promote. We do offer liquidity, and we let people directly invest. We think as long as we continue to deliver good performance, we'll continue to see the growth and exponential growth of our investor base. And we'll be the household name for any individual looking to access private real estate and be able to build a portfolio where they have not just equities or crypto, but also alternatives to give them diversification, a hedge against inflation, and good yield and income in an environment where that's pretty challenging to achieve otherwise.
Mhm. So, I mean, you're throwing some big numbers out there in terms of returns. I mean, 27, 28. That's nothing to sneeze at. Now that was also in this big kind of boom, right? That we had. We had these ridiculously low rates for a long time. So, can you talk about going forward? What kind of changes? I mean, do you think it's realistic to expect those kind of returns going forward? Do you think? I mean, with the rate changes with the rates going up, does that change the math on how profitable some of these deals are? Because a lot of times, I mean, real estate, it's about leverage, right? And if you're using that money, that borrowed money as your leverage and the rates change, I mean, that just changes the math on everything. So can you talk a little bit about those two things?
Absolutely. Yeah, we by no means are promising or even forecasting 27.5, 28% type net returns to our investors. And in fact, if you look at our underwriting, the initial sort of forecast and projections we showed for each of those properties that make up that portfolio that we've sold over every single one, we were hundreds of basis points below what we ultimately generated. So we always work to under promise, over deliver. And what I would say is going forward, it's going to be much tougher. There's no question about it, to be able to generate outsized returns because so much of the cash flow that many of these properties generated was propped up by low rates. And
Mm.
so you had positive leverage, and there are properties that we've seen that we've passed on where you almost have negative leverage because the debt's more than the cash flow, and
Mhm.
your unlevered return is much better, or at least much closer in line to your levered return. So I say all that to say, I think that the next couple of years in particular are really going to show, who's taken a prudent approach to investing, who's financially engineered returns, who's generated good operating returns based off of doing things like doing strong renovations of properties and making sure they're being managed to the optimal points, making sure there's not excessive costs, but you're still investing in right amenities. And so what we like to pride ourselves on is we find the best local operators and developers in every market around the country. We work and we partner and we align them. We give them great economics. We give them more controls than they would get if they were to work with just any traditional fund. And we let them do what they do best. We think just like in the equity markets, great management teams can outperform. The other thing we do beyond focusing on the operational side of value is we work in a way that we think is much more responsible from a leverage perspective. We're not levering these properties up 70% or 75 or 80%. And the reason that we're not levering them that way is because we don't have to, because unlike some of the traditional private equity funds, we don't have multiple layers of carry and promote. That was another innovation that we launched. In real estate, or I guess in hedge fund world, you hear about the 2 and 20. In the real
Right.
estate private equity firm, there's a double 2 and 20. There's a 2 and 20 at the fund level, and then the operators who run the properties, they actually get a 2 and 20 as well. So I said, I think it's crazy to be able to, pay that much in fees to all those different people. So I want to build a business where there's just one 2 and 20, if you will, which means that we're up to 30% lower in terms of fees than traditional funds, which means we don't have to take the same level of leverage or financial risk to generate 13, 14, 15% type returns. I always say not all 13% IRRs or returns are created equally. If you can generate that kind of return with lower leverage, then you can do so in a more responsible way. So we do think that we'll be able to generate alpha, great management, lower leverage. And then the final piece is just we believe in our methodology of market selection. We just announced the launch of our latest MVP, the most valuable places, which are our top markets around the country that we've used to really pursue investments. And we think if you pick the right markets, the right geographies, and have conviction that you can find pockets of growth, you can also generate great outsized returns. By no means am I saying that means 27.5 or 28% returns, but I am saying that I think, relative to alternatives, in equities and in other real estate options, we feel really good about our ability to deliver alpha.
Yeah. Well, Ryan, gotta just say, I really enjoyed talking to you when we met out in New York. Thank you so much for coming on the show here today. It's definitely something that I think our audience is not as familiar with. I mean, some of our folks are. I mean, like the reality is, some of our folks have made their money in real estate and
Yeah.
they're using stocks to diversify
Right.
their
Exactly.
portfolio in
Exactly.
that regard. Then there's, I mean, for me, I've made more money in stocks, and now I'm like, okay, let me try and diversify a little bit more into real estate. So some very helpful information. And where should people go to get maybe some more information to kind of understand
Sure.
how the real estate markets work, and
Yep.
specifically, your what you're doing here?
Yeah, absolutely. People should go to cadre.com, cadre.com. We actually have a hub for information, education content. The Cadre Insights blog actually gives a great overview of the various ways that people can understand certain asset classes and sectors. And then the Cadre Horizon Fund, people can sign up and invest in that on our platform as well. And so you can kind of both get the democratization of investments, but also the democratization of insights as well.
Mhm.
And it's all there on the website, the platform, and I'm grateful for the opportunity to speak to you and all your listeners as well.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.